Hello world, welcome back to my channel. If you're new here, my name is Tommy and I regularly make videos about personal finance, investment strategies and everything in between. Today we'll be exploring Alphabet Inc., Google's parent company. We'll discuss the overall business model of Alphabet, the quantitative and qualitative aspects of their various business segments, and using the information we can find, estimate the intrinsic value of the stock. If this interests you, subscribe and let's get started. When researching Alphabet Inc., one of the first things I read is this Google founder's letter. Let me read you the first paragraph. Quote, as Sergey and I, Larry Page, wrote in the original founder's letter 11 years ago, Google is not a conventional company. We do not intend to become one. As part of that, we also said that you could expect us to make smaller bets in areas that might seem very speculative or even strange when compared to our current businesses. From the start, we've always strived to do more and to do important and meaningful things with the resources we have. So this shows a lot about the DNA of the company. They are willing to take small bets in many projects that may not make revenue or profit in the immediate term. And as a long-term investor, this is something you have to be willing to wait, or alternatively, discount this away from your valuation, as these projects may not become growth drivers anytime soon. Next, let's take a look at the overall business model for Alphabet. More than half of their revenue comes from Google Search, 13% comes from the Google Network members, and this refers to things like AdSense and Google Ad Manager, paid services that allow advertising to appear at the top of web searches and so on. The other growth driver would be the Android ecosystem, where this includes paid apps on the Play Store, hardware sales such as Google Pixel and Chromebook, followed by YouTube ads, around 9%, and Google Cloud, around 5%. As you can see, despite having many speculative bets, as they would put it, it makes up less than 1% of the overall revenue. So you can look at it as either a lot of these projects are in the early stages, or it's not clear how many of these projects can become profitable at all. Next, let's take a look at some of the numbers. So top line revenue growth for Google has been very strong, growth in every single year between 2013 to 2017. However, you will note that the net income actually faced a loss in 2017 from 19 billion to 12 billion. So this is something that we'll have to explore. What happened here? Is this a one-off or is this a beginning of a systemic issue? In their earnings report for 2018, you can see that they rebounded very strongly from whatever happened in 2017. So you can see that both revenue and net income increased. In fact, they went from a net loss in diluted earnings per share to positive, which is a great recovery. In 2019, a pretty good year as well. Operating income stayed steady around 20%, and net income increased in line with revenue. In 2020, they had a good year as well. EPS increased, revenue increased. Operating margin actually increased a significant amount from 20% to 28%. So this might also be an anomaly, something to look into. In 2021, they had a phenomenal year. You can see that the increase in revenue is staggering from 182 billion to 257 billion, and the earnings per share almost doubled from $58 per share to $112. So I believe this is probably an anomaly because Google benefited a lot during COVID, where lots of small businesses had to were forced to digitize and advertise on Google's platforms. Next, let's take a look at the EPS numbers. So as you can see, EPS actually has grown exponentially over the past 10 years. This shows that Google has historically given a lot of value to shareholders. Next, let's talk about the shares outstanding for Alphabet. What I would want to see is a company that doesn't dilute its shareholders unnecessarily. Google has done it a little bit between 2013 to 2015, where they did issue out quite a bit of shares. But I don't think this doesn't seem to be a systemic issue. It has since plateaued and actually even slightly decreased, which is a good sign. In terms of assets to liabilities, both have increased steadily. Although I do note that the ratio of assets to liabilities actually has been declining, which means the amount of continued borrowing that Google can do is limited. This should not increase exponentially unless the assets that they own also increase exponentially. We don't want to see a company where the ratio of assets to liabilities is 1-to-1, let's say, because there's too much debt and will become very difficult to handle when interest rates increase. Next, let's take a look at some of their price ratios. So while Google's price actually has increased significantly over the past 7 years or so, you can see that the price to free cash flow ratio actually has stayed quite steady and is still trading around its average around 25 times price to free cash flow, which is, to me, in my opinion, quite reasonable for a tech company of its caliber, where the services are so entrenched in people's lives. They're also buying the possibility of certain moonshots from their other projects as well. Next, let's talk a little bit about the qualitative aspects of Alphabet. I'd like to start with how people view this company. In the tech sector, it is very difficult to not only hire great talent, but retain them as well. I'm really impressed that Sundar Pichai, the CEO of Google, has a 94% approval rate. That's I think higher than any other company I've seen. And 90% of Googlers would actually recommend working at Google to a friend, which is great. The company has a good reputation. It is known to be a great place to work, which this is really helpful for them to be able to sustainably acquire high quality data engineers, data scientists, machine learning engineers, and so on. In terms of search engine market share, you can see that Google actually has asserted its dominance for a very long time, holding more than 80% of search engine market share, way ahead of their competition like Bing, Yahoo, Baidu. The natural question to this is why? So one of the reasons why Google search became basically a monopoly in the Western world is that it was a superior product to its predecessors. So for example, Yahoo had organized its paid search service according to who paid the most. When advertisers can buy their way to a top spot, it often came at a cost of user experience. Whereas Google had a different business model. They focus on user experience. The algorithm focus on page quality, number of links, and relevance to a user's search in addition to how much advertisers pay. So this was an improvement over Yahoo's original model. And because Google provided the best product, everyone wanted to use it. Next, let's talk about the search engine market in general. The global digital advertising market actually is expected to grow at 13.7% for the next decade, which is good. Within the digital advertising market, the internet paid search market was the largest segment, and it is also poised to grow really well at 20.6% CAGR. So Google is in a fantastic position to benefit from this growth. However, let's take a look at some of the threats to Google search. Amazon is leading them in terms of Echo voice search technology, which has streamlined the consumer funnel significantly. And Google is still playing catch up with Google Home. Ad blocking is another threat to Google, where according to a report from Reuters Institute, half of all online customers actually use ad block technology. So this affects Google disproportionately more than other tech giants because they depend so much on advertising revenue. Thirdly, driving traffic and market share. So one example would be Facebook, which has gone from a social media platform to a news source, a place for live streaming, reviews, and referral platforms. So this takes away the users' time spent on Google platforms. So Facebook is a threat to Google. Users are becoming more and more aware of how much information is being tracked, and so it remains to be seen whether this is enough to drive users away from using Chrome, where our data is actually being tracked. So for example, alternative browsers like DuckDuckGo has been quite popular as well. So that's also a threat to Google. Next, let's talk about cloud. Google Cloud is actually the third biggest player in the market, trailing behind Amazon's AWS and Microsoft's Azure. Although you can see that over the past few years, they've actually been steadily growing their market share from 5% to 9% in 2020. So it remains to be seen whether Google can either steal market share from existing customers that are already in cloud, or attain a large amount of customers that are undergoing a digital transformation moving forward. So I want to look at a little bit closer at some of their competitors and the pros and cons of each platform to try to suss out whether GCP has a good chance in this fight. So AWS is the oldest and has the widest range of services. So what they have is the flexibility and a broad range of products that can suit most use cases. However, their weakness is actually that they focus on the public cloud, meaning they don't have as much enterprise support or on-premise kind of deployment setup. Microsoft's Azure advantage is that it's Microsoft, so it will work very well with all Microsoft ecosystem. This is really typical because most big tech companies use a walled garden kind of approach. Like how if you're an Apple user, it makes sense for you to own the whole suite of Apple products. Same for Microsoft. And what they have is enterprise performance. So I guess the advantage might be the ability to acquire some of the larger clients that have more specific requirements from their cloud provider. However, Azure doesn't have as much third-party integrations and also a limited flexibility. So GCP is the newest player and contains the fewest number of services. However, I think two big strengths that I want to highlight is that the Google ecosystem is really strong. So for example, you can integrate a Google Sheet into a BigQuery table very easily, and no other cloud service provider. Also, because of Google's involvement in many open source projects, there are a lot of opportunities to leverage these projects and integrate it back into your own GCP projects. However, some of the cons would be that they don't have a corporate agenda, so they might struggle to attract a certain type of clientele. I would imagine that GCP will be more popular among tech startups compared to huge enterprises. Next, let's talk about the global cloud computing market. So according to Grand View Research, cloud computing market is expected to grow at a 19% CAGR, which is fantastic news for Google. Next, I want to talk about Google's foray into the hardware business. So the Google Pixel has not actually been able to penetrate the smartphone market very well. In 2017, it was less than 1% of the US smartphone market, which is dominated by Apple and Samsung. And even today, the market penetration is not very high. What I understood about why this could be the case is that first of all, Google doesn't have many storefronts, and in some countries, no storefront at all for selling the Google Pixel. This probably prevents them from being able to capture a certain type of market. They also probably don't have they also may not have the capability to manufacture as many smartphones as Apple or Samsung. However, the Android ecosystem as well is doing very well for Google. So you can see that the Google Play Store and the Apple App Store have been almost neck and neck in terms of their growth rate, 16.8% CAGR. Fantastic growth, which means the Android ecosystem is holding its own against the iPhone ecosystem. Next, I want to talk about YouTube. So you can see here that the growth rate for YouTube has been amazing. Between 2019 and 2021, it was almost a 2x increase in revenue. And YouTube is a high margin business as well for Google. They don't have to spend a lot of capital expenditure once they've already set up their data centers to host videos. Another thing I like that captures the potential in YouTube is this answer from Sudha Pichai in one of the questions raised about YouTube during the most recent earnings call. So he said, and specifically on YouTube, while pretty early, there's a lot of pilots underway. We have introduced a creator tagging pilot program so that viewers get a choice to browse, learn, and shop products featured in their favorite videos. Piloted shopping live streams with brands like Walmart and Target, and more broadly, including product feeds more globally in video action campaigns. So there's a lot to do. Super early also on testing how shopping can be integrated with shorts. So again, early, but I find the opportunity space here pretty broad and it's exciting. This shows that lots of things are still being done in the YouTube space, and which means they might see even more growth going forward. Next, I want to talk about Google's involvement in the open source community. So I think this graph captures it really well. The number of active contributors for Googlers on public repositories hosted on GitHub and Git on Board has more than doubled since 2015 to 2019. So some of you might be wondering, why is that so important for Google, and how does this make it a good investment? So I would say that the ability for a tech giant such as Google to foster a community of talent is extremely vital to its business. They want to be able to hire the best engineers, but there's a limit to how many good engineers that can be produced in society in any year, right? So having Googlers being active on public repositories allows them to connect with the open source community, and therefore making hiring great talent a lot more feasible than if they otherwise were not active in the open source community. So think of this as sort of an intangible but vital investment in the ability for Google to hire talent so that they can continue to be a great software company. Some of the notable projects are Android, Kubernetes, that came out from the open source community. And more recently, Alphabet had announced that they are going to do a 20-for-1 stock split this year. So the good thing about this is that because Alphabet's very expensive in terms of price per share, having a 20-for-1 stock split means that a lot more young investors are able to get in on this. And for existing investors, it allows you to reach a point where you can sell covered calls a lot earlier. So I think this is a good thing for Alphabet, even though a stock split actually technically doesn't change anything in terms of your percentage ownership of the company. But historically, stock splits have been beneficial to the stock price, at least in the short term. Next, I want to talk about what happened in 2017. So if you recall, we had a steep decline in earnings in 2017. So what happened was that they actually had to pay a $2.7 billion fine to the EU in 2017. And this caused the company's net income to fall significantly. What's more important is this a one-off or is this a systemic issue? And it turns out that Google has been fined quite a lot, 3 times in 3 years by the EU, 2.7 billion in 2017, 5 billion in 2018, and then 1.7 billion in 2019. So personally, I would look at it as a cost of business rather than a one-off. I'll take this into account when trying to give a intrinsic value estimate for this stock. So given all the information that we've gone through so far, I decided to put together a DCF valuation to estimate the intrinsic value of the stock. Shout out to Sven Kalin for providing the template DCF Google Sheet on his YouTube channel. For those of you who are interested in doing your own DCF calculation, feel free to check it out. So most of the markets that Google are in seem to be in high growth territory. So I would expect Google to be able to grow somewhere between 15 to 25% in the next 5 years. And based on the sum of parts valuation, we come up with a value of about $1.7 trillion, which is right around where the stock is trading at. So to me, Alphabet is not a screaming buy at the moment. However, I would bear in mind that the price to free cash flow multiple for a high quality business such as Alphabet rarely goes to a very low number. So to me, this is not one of the cases where I will wait for a crisis to come, because Google has been very resilient even in crisis. I will look at Google as both a defensive play as well as a growth play, although I will not expect anything close to a 10-bagger with this stock. However, it has a place in my portfolio, which is why I've decided to dollar cost average into Alphabet. Of course, this is not financial advice, and you should do your own due diligence before making any decisions in the stock market. We hope you have enjoyed our analysis of Alphabet Inc. If you'd like to hear more content from us, do subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with your friends and family. We'll see you in the next video.